All right, class. So this week we're going to look at capital structure, which is chapter 13. So let's get into our objectives, right? So we want to describe capital structure, financial leverage, recapitalization, and the trade-offs associated with changing our capital structure. We want to explain the Modigliani and Miller propositions, or M&M props 1 and 2, and the impact of using financial leverage if capital markets are perfect. We also want to discuss the impact of corporate and personal taxes on those M&M propositions. We're going to discuss the trade-offs of benefits and costs that arise from using financial leverage, particularly those related to bankruptcy costs as well as taxes, and how the use of debt affects those agency costs. And then finally, we're going to look at the pecking order and signaling theories, okay? So, capital structure is simply the mix of long-term debt and equity securities that a firm uses to finance their activities. The optimal capital structure is one that maximizes firm value and minimizes that WACC, okay? Financial leverage are borrowed funds that impose a fixed financial cost on the firm and magnify the effects of changes in underlying business conditions on the returns that shareholders may earn. A firm that uses debt financing is a levered firm, and a firm that relies on equity to finance their activities is an unlevered firm, right? Business risk. This is risk that stems from the firm's business activities, but not its financing strategy. Recapitalization is a pure change in a firm's financing mix, not tied to capital raising to fund new investments, okay? So let's look at electric motor corporations, EMC, for an example. Currently unlevered capital structure, so they don't have any debt. They have 1 million shares of outstanding common stock. This year and every year in the foreseeable future, investors are expecting net operating profits, or NOP, of 18 million. Based on EMC's business risk, the shareholders expect a 10% return. So we're going to ignore taxes right now. So EMC's net income is equal to its NOP, right? So that's the 18 million divided by 0.1. That's the return, is equal to 180 million. So their net income is equal to the NOP, right? Their stock price is that 180 divided by a million, right? They have a million outstanding. So that's $180 for their stock price. The EPS is that 18 million divided by the million outstanding, so $18. So if EMC pays out all earnings as a dividend, then shareholders receive 18% or $18 on their $180 investment. So their return on equity is equal to the 10% that they required, right? So everything balances out here. So the proposal now, we want to issue bonds and use the proceeds to buy back some of the outstanding stock. We're going to sell $90 million worth of bonds paying 7% and use those proceeds to repurchase half of that outstanding common stock. This recapitalization would shift their mix of financing from 100% equity to a mix of equity and debt. So they're going to buy back the outstanding stock, leaving 500,000 outstanding. And ignoring those taxes, the annual net income will be 18 million less the interest expense of 6.3 million, which is taken by 90 million times 0.07, or 11.7 million. So their EPS is equal to the 11.7 million divided by the outstanding shares now at 500,000, so $23.40. And the return on equity now is now 23.40 divided by the price of 180, or 13%. So here's their share and return on equity under the unlevered and the levered structures for the three scenarios. So we have an economic recession, right? So this is where we have 100% equity financing, and we can look at the 50-50 equity debt financing, okay? So operating profit is 9 million in a recession. The interest will be on the 50-50 debt equity portion, right? So the net income for equity financing is 9 million, 50-50 is 2.7 million. Outstanding shares, we have a million under financing, 100% equity. Under the 50-50 ratio, it's 500,000. So the earnings per share is obviously lower when we have 50-50 equity and debt. Share price remains the same, but the return on equity then goes down in a 50-50 situation. In a normal economy, we can see that the company is, operating at that 18 million. There's interest to be paid out. So our net income is a little bit lower under the 50/50 share. But outstanding shares, we can see an increase in the earnings per share under a 50/50 equity and debt ratio there. And the return on equity there is 13%. And a rapid economic expansion, say we bump it up to 27 mil. So then we're looking at earnings per share under equity financing at $27 and under that 50/50 ratio, 41.40. So again, we can see here the return on equity is also increased under that 50/50 equity and debt. So here is that sensitivity change to that net operating profit. So again, 12.6 for millions, that's the break-even point, 12.6 earnings per share. So above that, we can see how the blue line is higher in a 50/50 capital structure than the unlevered all equity capital structure, which is the lighter blue, like teal colored line, to see how that looks, right? So we can calculate that expected net income, EPS, and return on equity if we assign probabilities to each economic scenario. So if there's a third of a chance that each outcome will occur, then we're going to use all that information to calculate the EMC's net income, EPS, and ROE under each structure. So with unlevered 100% equity financing, our expected unlevered net income is going to be 18 million. So this is taking a third of each of those scenarios, right? 9 million, 18 million, and 27 million. Then we have the expected unlevered EPS. So $9, $18, and 27. Again, taking a third of each of those, it comes out to $18. And then the unexpected unlevered ROE is a third of 5%, 10%, 15% to get 10%. With the 50/50 financing, we're looking at taking a third of the 2.7, the 11.7, and the 20.7. The expected levered EPS is now 23.40, and the expected levered ROE is 13%. So while substituting debt for equity increases the shareholders' expected returns, it also increases the risk that they're facing, okay? So the risk that stems from those fixed expense financial leverage imposes is an expense the firm has to cover regardless of how their business conditions are operating. With this, we can figure out what that degree of financial leverage is. So we can say that the DFL is equal to the percentage change in EPS divided by the percentage change in NOP. So we've already seen that EMC's operating profit is 12.6 million. Their earnings per share are the same at 12.6, whether the firm has leverage or not. So consider this the base, okay? Let's see what happens to EPS when NOP moves. So NOP is going to move from 12.6 million to 18 million. It's an increase about 43%. If the EPS increases to $18 if the firm has no debt, which is also an increase of 4.3. So the DFL is equal to 1.0. Now consider what happens if NOP increases from 43% to from the 12.6 million to 18 million if the firm's financing mix is 50/50, okay? So we're going to see here that the EPS increases to 23.40, a jump of about 86% from the base of 12.60 per share. So now the degree of financial leverage with the 50/50 mix is 2.0. So if you repeat those calculations for a scenario where the NOP falls anywhere between the 12.6 and 9, which is the recession scenario, you're going to find the DFL equals 1% in all equity case and 2.0 with the debt equity 50/50 ratio, right? So financing the business with 50% debt makes the change in EPS twice the change in NOP, whether that NOP is rising or falling, okay? So it's also possible to calculate the degree of financial leverage for a base level of NOP using this equation 13.2, where PD is the preferred stock dividend and T it's the tax rate. And because a leveraged capital structure increases risk for the shareholders, they're going to require that higher return. It's called risk premium. They want that as compensation for a higher risk, right? So whether we're adding debt to the firm's capital structure increases its stock price depends on the balance between two things: the increase in cash flows that the shareholders are going to expect versus the higher discount rate that they use to value those cash flows. So in path-breaking work, Frank Modigliani and Merton Miller described conditions under which these effects exactly offset each other. So the firm's value is unrelated to its capital structure, and adding debt to or subtracting it from that capital structure has no impact on the firm's value. So this is called the M&M, and this is their research. So changes in the debt equity mix merely altered the distribution of a firm's cash flows between the stockholders and their lenders, okay? So the capital structure shift had no effect on firm value, and they proved their point in the context of a perfect market, which means that one, investors and firms face no market friction such as taxes or transaction costs. Two, those investors and firms can borrow and lend at the same rate. And three, investors and firms have access to the same information. There are no asymmetries, okay? So this is capital structure irrelevance in perfect markets. But those real world markets, they don't satisfy any of those conditions. But there are two reasons why M&M's conclusions remain significant that we need to know about. It's helped managers see those market imperfections that influence the optimal capital structure decisions. Their argument rests on the no arbitrage principle, which is also called the law of one price, which says identical assets cannot sell at different prices. Opportunities to earn a risk-free profit should be very scarce in a well-functioning market. And arbitrage is simultaneously buying and selling the same asset at different prices to earn an instant risk-free profit, okay? So proposition one, value is independent of financing risk. So this states that the value on the present value of the cash flows generated by its assets, not on how those cash flows are divided among investors through capital choice, right? Structure choice. So V equals E plus D, or that is also equal to the NOP over R. So consider an example in which two firms are alike in every way except their capital structures. M&M says that the values of those two firms have to be equal to prevent that arbitrage. Okay, so table 13.2 summarizes those key facts for two firms, No Debt Co. and Debt Co. Just made up, right? So let's take a look at that. So the NOP, the net operating profit, $2 million for each, less interest paid, which is 0.05 times D. So our net income is $2 million for no debt. We don't have any debt. That's what the D stands for, right? And then Debt Co. has 625 for interest paid. So their net income is a little bit lower. They both have that same required return, the 8%. The total firm value is going to be the NOP divided by the return. So again, because the NOP is the same for both, the total firm value will be the same. Shares outstanding is a little different. So then we have market value of equity. So 25 million for no debt and 12.5 for debt, right? Because that's their equity. So Debt Co. has some debt. So this is not all going to be an equity. The interest rate on their debt for Debt Co. is 5%. So the market value of their debt is 12.5 million, okay? Price per share is going to be the same. So the earnings per share, though, is going to be a little bit different. It's going to be a little bit higher with Debt Co., right? So the required return is 8% with no debt. Again, that's the required return. And it's going to be a little bit higher for Debt Co. because they have debt. So it's riskier for those shareholders. They're going to require that increase in price. So we can use homemade leverage to prove proposition one. So in table 13.2, both firms were worth that 25 million, but the values distributed differently between the debt and equity investors. Now what happens if prop one says, that's not true. One firm is more valuable than the other. So we're going to look at this one that says that this violates proposition one for M&M, right? So ultimately, this would be saying that, the total firm, the equity plus the debt now makes Debt Co. More valuable, right? They also have a higher return. Under the assumptions of the perfect market, investors can easily profit from this type of situation. An investor could earn an arbitrage profit by selling Debt Co. shares and buying a little less expensive no debt stock. And to complete that arbitrage, the investor is going to engage in selling $1,000 of their shares, so they get $68,750. They're going to borrow $62,500 at 5%, and they're going to purchase 2,000 shares, right? So their funds remaining are $62,550. What did that transaction accomplish, though? Initially, they owned 0.5% of Debt Co.'s equity. After making that transaction, the investor owns 0.5% of no Debt Co.'s equity now, but also has outstanding personal debt of that $62,500. So they're going to use that 62,500 in homemade leverage to cover half the cost of buying into no debt shares. What's homemade leverage, though? So this refers to an investor's ability to substitute personal borrowing for corporate debt. It allows the investor to replicate the return on a levered firm while investing in an unlevered company. So holding 0.5 of DebtCo's levered stock is equivalent to holding 0.5 of no DebtCo's unlevered stock and financing half of that investment with personal debt. There is an arbitrage opportunity because after selling DebtCo shares, borrowing money, and buying no debt stock, the investor has $62.50 in cash left over. That represents the arbitrage profit. This opportunity cannot survive in the market for long. So as investors sell DebtCo's overvalued shares to buy no DebtCo's comparatively undervalued stock, the price of DebtCo shares will fall and no debt shares will rise. So soon the market's going to reach a new equilibrium and where the total market values of the two firms are just identical, just as Proposition 1 predicts. The important takeaway is that profit-seeking activities investors will ensure that this proposition holds, okay? So under perfect market assumptions, investors can undo any changes in the capital structure with their own homemade leverage, and a firm can choose any capital structure it likes without affecting its total market value. Proposition 2, the WACC is independent of the financing mix. It states that the expected return on a leverage firm's equity, RL, increases with the debt to equity ratio in a way that leaves the WACC unchanged, okay? So RL is equal to RA plus RA minus RD times debt over equity, right? That's in 13.4. So RA equals RI times equity over equity plus debt plus RD times debt over equity plus debt in 13.5. Under Prop 2, the WACC does not depend on capital structure and the term RA is constant. If the WACC is not influenced by leverage, then neither is the value of the firm, which is just the present value of future cash flows discounted at the WACC. So that's the connections between Prop 1 and 2. So calculating WACC for no debt and DebtCo. So we can see the WACC for no DebtCo is 8%, and the WACC for DebtCo is also 8%. So here's the case of perfect capital markets here. We also need to look at M&M and taxes, okay? So corporate taxes in the U.S. allow firms to deduct interest payments as a business expense. Dividends to shareholders are not deductible, and the interest deduction reduces the firm's tax bill. So intuitively, this tax advantage for debt should mean that managers can increase firm value by issuing debt. So let's take a look at no debt and DebtCo with their corporate income taxes. Again, 21%, right? So the net income of no debt is 1.58 and debt is 1.086 and some change. So the total income to investors is their interest on bonds plus the net income. So we see that no debt is 1.58 and with debt we're looking at the 1.086 plus the interest on the bonds, which would be that 625 that they paid up at the very top. So we get 1.711 and some change. So the value of the tax shield is going to be 0 for no debt because they don't have any interest paid, no debt there. But on debt side, we see 131,250. So the corporate income tax creates that government claim on firms' cash flow, and the value of that claim is the present value of taxes that the firm's paying. By using debt, they're reducing their tax bill and the value of the government's claim for DebtCo. By shunning debt, no DebtCo maximizes the stream of taxes that it pays, and in doing so, it maximizes the value of the claim that the government holds on them. So higher tax payments mean that no DebtCo has less cash to pay their investors, which reduces the value of that company. A modified version of 13.3 that we saw earlier allows us to calculate the value of no DebtCo by adjusting the numerator to account for taxes. Okay, so NOP times 1 minus T, which is the tax, divided by R, the rate. So in a perfect market without taxes, no DebtCo's market value was 25 million. With taxes, no DebtCo's value is equal to 1.5 times divided by the 0.8 or 19.75. The 21% corporate tax causes the company's value to drop by 21%. or 5.25 million, which is a transfer of wealth from no debt co shareholders to the government. By borrowing money and paying interest that is tax deductible, no debt co can shelter some of those tax flows from taxation, which increases its value. So there's a debt tax shield that is a savings that's created by having that tax deductible interest expense on debt. So we can see that the PV of the debt tax shield is equal to the rate times debt times tax divided by the rate. So we can really see that it's the debt times the tax, right? So with that, we can apply that to debt co. So their present value of the tax shield is 12.5 times 21% or 2.625 million. And then we look at equation 13.8. The value of debt co is 19.75 plus that 2.625, and we get 22,375. Okay. So by making tax deductible, the government has given debt co a 2.625 subsidy to borrow money rather than use all equity financing. Ultimately, shareholders are reaping the tax benefits of debt financing. Interest deductions reduce payments owed to the government and increase the cash flows available to shareholders, where they are the residual claimants and receive all cash flows left after all debts and taxes are paid. So in this example, the 2.625 million increase in firm value is reflected in that same increase in the value of the firm's common stock, okay? So here is the effective leverage on firm's value with and without those corporate taxes. So panel A is without taxes for both the net debt, no debt co and debt co. And then panel B shows you with taxes. So no debt co and debt co. You can see that the pie chart, the piece of pie that is for taxes is much smaller than that of no debt co. We need to look at personal taxes too. In a perfect market, capital structure doesn't matter at all. But in a corporate tax, the optimal capital structure is 100% debt. Companies usually don't maximize that leverage. They're neither at 0 or 100% debt, right? So why do real world capital structures not conform to the theory? With personal taxes, debt enjoys a tax advantage at the corporate level and a disadvantage at the personal level. Interest payments that individuals receive are often taxed as ordinary income, and dividends and capital gains are taxed at lower rates, though. So here is equation 13.9 is our gains from leverage. So G is our gain. Excuse me. TC is our tax rate on corporate profits. TPS is our personal tax rate on income from stocks. Those are our dividends and capital gains. And TPD is our personal tax rate on income from debt, like interest income. And D is our market value of a firm's outstanding debt. It shows financial leverage can increase, decrease, or have no effect on firm value depending on that tax code. Prior to the Tax Cuts and Jobs Act of 2017, which established that 21% flat corporate tax, corporations face a progressive income tax system with a top marginal rate of 35%. To get a sense for the impact tax law changes that can have on a trade-off between equity and debt financing, consider the following situation before and after this act. In a given year, a certain firm is capable of earning net operating profit of $5 million by operating assets financed entirely either with equity or debt. With all equity financing, the firm's going to pay out of pocket all tax operating profit as a dividend to stockholders. And with all debt, the firm's going to distribute the entire pre-tax operating profit to debt holders in the form of interest payments, okay? So before the act, the net operating profit of $5 million was subject to the average corporation tax of 34%. The personal tax rate on dividends was 20%, and the personal tax rate on interest income was 39.6%. After the act, a net operating profit of $5 million is subject to the corporate tax rate of 21%. The personal tax rate on dividends was 20%, and the personal tax rate on interest income was 37%. So here is a summary of the differences of before the act and after the act. So we can see, at the end, the after-tax personal income after the act was established increased, okay? So before the tax law changed, the firm's operations were entirely equity financed. It paid out after-tax profit of $3.3 million as a dividend, And after paying the 20% personal tax rate on dividend income, stockholders earned after-tax personal income of 2.64. If the firm's operations were entirely debt financed, the entire $5 million flowed to debt holders escaping those corporate taxes. After paying the 39.6% personal tax rate, debt holders had the after-tax personal income of a little over $3 million. So the difference was $380,000 in favor of debt financing. Immediately after the act, if the firm's operations were entirely equity financed, it paid out a larger after-tax operating profit of that 3.95 as a dividend. Having paid that 20% personal tax rate, stockholders had after-tax personal income of a little over $3 million. If the firm's operations are entirely debt financed, the entire $5 million flowed directly to debt holders. So after paying that 37% on a personal tax rate, debt holders had after-tax personal income of $3.15 million. So this is a difference of $10,000 in favor of equity financing. So this understates the advantage of equity financing under both the Act and the subsequent CARES Act, because both laws imposed a limit on how much interest a firm can deduct for tax purposes. Under the new tax law, both equity and debt holders receive more cash, but on the whole, the large reduction in the corporate tax rate reduced the value of debt tax shields sufficiently to tilt things in favor of equity financing. It's now a fixed 21%. The trade-off between equity and debt financing will vary as a function of those personal tax rates on dividend and interest income. So it illustrates how by changing the corporate and personal tax rates, legislatures can change that relative benefit of using debt and equity financing. So let's look at trading off debt benefits and costs. Okay, we've already learned that in a perfect capital market, a capital structure choice doesn't really matter, but that prediction doesn't align with what the execs say, right? They place great importance on financing decisions and believe that they have a significant impact on firm value. So this suggests that markets are imperfect in one important way. Taxes are such an imperfection, right? In principle, even though personal tax considerations can partially or fully offset that corporate tax advantage that debt enjoys, it's not clear that the execs routinely take into account the personal tax positions of their shareholders when they make those decisions. Because most firms don't lever up as much as they could, there's other costs of debt that managers have to think about besides those personal tax costs. We're going to look at a figure that offers a conceptual framework to understand how managers trade off debt, benefits, and costs. Marginal benefits fall and marginal costs rise as debt increases, okay? So here's that figure. So in panel A, we have optimal capital structure, where we have a perfect debt to equity ratio. That's our optimal capital structure. When we have too much debt, we see that the marginal costs are over the benefits. When we have too little debt, our benefits are over the costs. Panel B is our total firm value, where we want to be right at that peak of that bell curve for our optimal capital structure. And for our WACC, we want to be at the lowest, right? We want to be at the lowest WACC for our debt to equity ratio. The tax benefit of debt will eventually fall as debt rises. So with higher debt and higher interest expense, the chance a firm's going to experience loss and maybe miss or postpone the benefit of a tax deduction, that actually goes up. So there's a declining marginal tax benefit of debt. In March 2020, the ride-sharing service Uber reported its financial results for the quarter. The company's income statement showed interest expense of $217 million. For a profitable company, that level of interest would save $45.6 million in taxes, which is 21% of that 217. But unfortunately, Uber was not profitable. Business tax laws permit firms to carry forward losses and deduct them against income in future years, provided that those losses don't exceed 80% of income in the future year. Although Uber's interest payments would not save the company taxes in 2020, it's possible that some tax savings might arrive in future years. Of course, due to the time value of money, tax savings today are worth more than future tax savings, right? In addition, their past results portend future losses, as the company's only profit came from selling off part of its business and not from ordinary operations. At the margin, the benefit of borrowing more declines as leverage increases. And just as benefits of additional debt fall, the more debt a firm uses, the higher those costs of debt rise as that leverage increases, okay? So here's how the probability of losses arise with debt. So when we have no debt, we have a larger chance to hit profit than we do a loss. With moderate debt, it's still, within a good 67 ish percent to hit a profit and 33-ish percent to hit losses. When we have a lot of debt, we have a higher chance of hitting a loss than we do of hitting profit, okay? So there's that increasing marginal cost of debt, which could potentially be bankruptcy, where a firm can't meet their debt obligations. It's the legal process where the firms may reorganize or liquidate and address creditors' claims. Sunnybrook, New York has awarded 1-year road maintenance contracts to 2 companies, Low Road and High Road. The value of these contracts depend on the amount of snowfall during the upcoming winter. So if snowfall is above average, each company will earn a fee net of maintenance costs of $450,000. And if snowfall is below average, each will net $100,000. It is equally likely that the snowfall in Sunnybrook will be either above or below average. 50-50 chance, okay? To finance the cost of maintaining Sunnybrook's roads, both companies issued short-term bonds that mature in 1 year, but High Road borrowed more money and used more leverage than Low Road. So Low has to pay $53,000 in principal and interest in 1 year, and High has to pay $135,000. So if the winter snowfall is below average, High is going to declare bankruptcy because they're not able to pay the bond obligation in full. If this happens, their stockholders will lose their investment and their bondholders receive that $100,000 management fee. High's bondholders are promised a 10% return, and their stockholders require a 13.5415 rate of return. Low's bondholders and stockholders are both willing to accept slightly lower returns because Low uses less financial leverage. So the bondholders want 8% and the stockholders want 13%. With simplifying assumptions, we're not talking about taxes. The following table details the payoffs to stockholders and bondholders for the firms. So Low Road, with an above average snowfall, we're looking at distribution to stockholders of $397 and principal and interest payments to bondholders of $53,000. With High Road, we're looking at above average snowfall. Again, cash flow is the same here, $450. The payment to bondholders is $135 here, right? So their distribution to their stockholders is at $315. When it's below average snowfall, we still have cash flow of $100,000. All right. So if it's below, it's at 100. The payments to bondholders for Low Road do not change. They're at $53,000. Whereas High Roads go down to $100,000, right? Because that's the only cash that they have. And they have to get $135. So they aren't able to distribute anything to their stockholders. High is not. However, out of that $100,000, Low Road is able to distribute 47 of that back to their stockholders. That would be the 100 minus the 53. So the equity E and debt D for values for Low and High equal the present value of the expected payoffs to each investor group found using the required returns to discount the cash flows. So the firm's value V is equal to the sum of values for equity and debt. V equals E plus D. Remember, there's the 50% probability of above or below average snowfall. It's equal. So E low is going to be 0.05 times 397 plus 0.05 times 47 divided by 1.13. Remember, that's the return the stockholders are requesting. So that equals 196,460, right? So that's their equity. D for Low is 0.5 times 53 plus 0.5 times 53 divided by 1.08. Remember, this is the bondholders, the 8%. So that equals 49,074. So the value of Low is the 196 plus the 49. So we get 245,534. When we look at High company, the equity here is equal to 138,716 using the same formulas. The debt is equal to 106,818, and the value totaling those two is 245,534. So we see a higher financial leverage means that High's bondholders and stockholders bear more risk, okay? But if High goes bankrupt, ownership transfers at no cost from stockholders to bondholders, okay? As a result, both High and Low are worth 245,534, and the fact that one firm borrows more than the other is irrelevant when bankruptcy is costless. It's also worth noting that the weighted average cost of capital for maintaining roads is 12% for both firms. So given the M&M positions, it's not surprising that High's WACC is the same as Low's. Investors take into account expected bankruptcy costs when they decide what they're willing to pay for a firm's securities. The more a firm borrows, the higher the likelihood of that bankruptcy, and the higher our expected bankruptcy costs. One reason why the marginal cost of using debt increases with more leverage, we're going to look at a figure that shows that. There's direct bankruptcy costs. These are fees paid to lawyers, accounting firms, investment banks, consultants engaged in that bankruptcy proceedings. Indirect costs are exceeding those direct bankruptcy costs. They could be the loss of customers and suppliers, the time that distracted managers devote to the bankruptcy process rather than actually running the business, the departure of key employees, lost investment opportunities. So because bankruptcy costs decrease a firm's value and because using more debt raises the likelihood of bankruptcy, bankruptcy costs create a deterrent to using debt. So let's reconsider low and high road, right? Two firms operating same business using different amounts of debt. In addition to the assumptions made previously, Haya has to file for bankruptcy due to the meager snowfall. The process is going to be costly. They're not going to simply hand over the full 100,000 management fee to the bondholders. Instead, because of the bankruptcy costs, only 60,000 will remain to satisfy lenders' claims. So they're going to transfer ownership from their stockholders to their creditors. It's expensive. That's going to consume about $40,000 of value. So here is that indicating the bankruptcy costs. So we can see with high road, it's 40,000 there. So everything to bondholders is 60,000 there. Okay. Under these new conditions, the expected value of debt and equity securities are not the same for each company. So let's take a look at low road now. So again, with low, we came out to 245, 534. Nothing changed with them. They're not going through bankruptcy. But high, on the other hand, their value actually dropped their overall firm value from the bankruptcy. Okay, so it's now valued at 227, 352. So it decreased it by $18,182. There's a trade-off model that we can look at, right? The bankruptcy cost affects firms' decisions regarding leverage. So going bankrupt triggers costs that reduce our value. So a lot of managers and investors can estimate that expected cost by multiplying the cost if the bankruptcy occurs times the probability that the firm's going to go bankrupt. So with an estimate in mind of what those costs are, managers can weigh that against the tax benefits, okay, of the debt. So here's a figure that shows that trade-off, incorporating taxes and bankruptcy costs. Again, we want to be at the top of the bell curve. That's our debt to equity ratio where we have that optimal capital structure. But if we see here, the difference between the purple line and the green line is our value of expected bankruptcy costs, okay? And then the blue line is our value of lost debt tax shields. So this illustrates the trade-off between tax benefits of debt and the increased expected bankruptcy costs that accompany that higher leverage. So the optimal capital structure occurs when the marginal value of tax benefits equals the marginal increase in expected bankruptcy costs. So at that point, the firm's value is at a maximum. So VL is equal to VU plus PV times our debt tax shields minus our PV of bankruptcy costs, right? That's our new equation. We can look at asset characteristics and the bankruptcy costs. So indirect bankruptcy costs, they tend to be more important than those direct costs. They're likely to differ from one firm to another. The type of assets the firm uses to conduct its business influences that capital structure. So companies whose assets are tangible and are regularly traded in those secondary markets should be less fearful of bankruptcy than companies whose assets are largely intangible. These firms tend to borrow more heavily than firms with few tangible assets. A lot of these are like trucking companies, construction firms, some retail establishments. We also need to look at other factors that influence our capital structure choices, like agency costs. Managers act as agents of the stockholders. The owners give managers authority to manage the firm for those owners' benefits. The agency problem created by this arrangement extends not only to the relationship between owners and managers, but also to that of owners and lenders. So we need to look at agency costs of outside equity. So when a person owns all of the company's stock and manages the company, there's no separation between ownership and control. So the owner bears all the costs and reaps all the benefits of their actions. Once the original owner sells the stock to other investors, called outside equity, They bear just a fraction of that cost of their actions that reduce the firm's value. It creates an incentive to engage in behavior that is harmful to outside shareholders, okay? So an example, the founder of an equipment company in Pittsburgh must travel to Komatsu headquarters in Tokyo, Japan for certification on their super large hydraulic excavator. First class airfare on American Airlines is sky high 12,944, whereas main cabin airfare is more 882. If they buy a first class ticket, assuming no additional benefit to the firm, the founder is going to fly first class rather than the main cabin, and the company's rental value, the company value is going to fall by 12,062, which would be that 12,944 minus 882. If the founder owns 100% of the company, then her personal wealth bears the full incremental cost of that ticket. However, outside investors, if they own half the company, then they in fact pay for half of that cost, or 6,031. So suppose an entrepreneur owns some fraction X percent of a firm's shares and outside investors own the rest, 1 minus that X percent. The founder wants to enjoy perks like first class air travel. She personally bears X percent of the cost, while the other shareholders pay for the rest through a reduction in the value of the shares that they hold. The greater the fraction of the firm earned by the outside shareholders, the stronger the incentive for the founder to consume the perks. Investors are aware of these incentives. They're going to pay less for the shares in the first place based on that expectation the managers are going to consume perks at their expense. The founder is going to ultimately bear the cost of the perk consumption, which creates a disincentive to sell stock to outsiders. So debt offers a partial solution to this problem. So selling debt allows a firm to raise the capital it needs without selling as much outside equity as it would otherwise be necessary, and the obligation to meet principal and interest payments acts as a restraint on managers. So there's a bonding mechanism that we could look at where managers are using debt to commit not to exploiting outside shareholders who will then pay a higher price for the firm shares. Debt subjects firms to direct monitoring by credit rating agencies, banks, public capital markets. It also puts a limit on how much value the managers can destroy through incompetence or lack of effort. Managers who use debt also risk being replaced, which reduces the agency cost of that manager-shareholder relationship. Okay. A deteriorating financial solution can give managers troublesome incentives to exploit their bondholders. So with that, we look at the asset substitution problem, which promises to invest in a safe asset commensurate with a low return, but then risking, substituting out a riskier asset that offers the prospect of a bigger payoff that will most likely benefit the shareholders. So J.R. Ewing has 100 million in bonds outstanding that mature in 90 days. They were issued a long time ago when Ewing was financially strong. Now the company's losing money. The managers believe the firm can recover once the economy rebounds. But despite the losses, the firm has 80 million in cash on hand that it can invest in one of two projects, or it can simply hold the cash in reserve to pay the bondholders as much as possible in 90 days. The first investment costs 80 million. It most certainly will pay off 81.5 million in 90 days. This is a quarterly return of 1.88%, or an annual return of almost 8%. Because it entails very little risk, it's a positive NPV project that's worth undertaking, but it won't be enough to fully repay those maturing bonds. The second investment is a huge risk. It requires 80 million as well, but offers a 40% chance of a $120 million payoff and a 60% chance of a 40 million payoff. Its expected payoff is only 72 million, so it's got a negative NPV. The firm really should reject it, and the managers would do so if not for the outstanding debt. If the project generates a low payoff, the firm will go bankrupt, but it's headed there anyway. The high payoff, though unlikely, is sufficient to repay the bondholders and allow the firm to continue as a going concern. Managers have perverse incentives here, right? The bondholders that prefer that managers either undertake the low-risk project or just sit on the cash reserves. But that's not what shareholders want. They will lose everything if bondholders aren't paid. The shareholders are playing with the bondholders' money. If it succeeds, the risky project will generate enough cash to pay off the creditors and leave the shareholders in control. If not, those shareholders hand the firm over to the bondholders, which is the same result achieved by playing it safe. So shareholders have everything to gain, nothing to lose from swapping to a riskier asset for a safer one, and their agent or the manager controls the firm's investment policy. Bondholders can insist on restrictive covenants that protect them to only some degree against asset substitution, but it's only a partial solution. So we need to look at underinvestment problems. This is where an agency problem that occurs when managers pass up a good investment opportunity because undertaking it would benefit lenders rather than their shareholders. So again, let's look at Ewing, right? They're on the verge of bankruptcy because it's 100 million in bonds comes due in 90 days, probably won't have the money to pay them. So assume a very profitable short-term investment opportunity comes along. Perhaps a financially distressed supplier agrees to sell its inventory at a deep discount if they can pay cash today. The inventory costs 90 million, but they can sell it for 190 million in 90 days. They rake in 100 million profit just to pay off the debt. The company has 80 million in cash on hand, so take advantage of this. Shareholders have to pitch in another 10 million, okay? They can either sell new shares or cut dividends. By accepting this project maximization, the value of the firm because of the investment's enormous NPV. However, shareholders reject this idea. They would contribute an extra 10 million to make the investment, but the rewards all go to the creditors. So, a study of the use of long-term debt in 42 countries found that firms in Argentina used more long-term debts than firms in any other country. Firms in Argentina used almost 60% more long-term debt than U.S. companies. Indian firms were heavy users of long-term debt as well. At the other end of the spectrum, companies from Italy, Greece, and Poland used very little long-term debt. They used about only 40% as much long-term debt as did their U.S. counterparts. So we can also look at asymmetric information. It's a situation where all economic agents don't share that same knowledge, right? There's the pecking order theory, the financial slack. This refers to excess financial resources and includes a firm's cash and marketable securities, in addition to the unused debt capacity. The pecking order theory is hierarchy of financing that begins with retained earnings, which is followed by debt financing, and finally external debt, equity financing. Sorry, not debt. We can look at signal theory. So signal is a financing action by management that reflects its view of the firm's stock value. Usually debt financing is a positive signal that management believes stock is undervalued, and a stock issue is a negative signal that management believes the stock is overvalued. So this signaling theory predicts the firm's stock price should rise when it issues debt and fall when it issues equity. And this is exactly what happens in the real world much of the time. So what did we learn in this chapter? We learned how to describe capital structure and how that's a mix of debt and equity securities. We looked at financial leverage to, use borrowed funds. We looked at recapitalization. We looked at trade-offs associated with changing the capital structure. We looked at debt financing or financial leverage. We looked at adding debt to the capital structure increases our overall risk that the shareholders bear, so they want a higher compensation for that additional risk. So whether the addition of debt to the firm's capital structure increases their stock price depends on the two offsetting effects. So the increase in expected cash flows versus the increased discount rate that the shareholders are applying to those cash flows. We looked at the M&M propositions 1 and 2 and the impact that they have on frictionless capital markets. Proposition 1 states leverage choice does not affect a firm's value. Proposition 2 says that even though the cost of debt is less than the cost of equity, the WACC does not decrease when a firm's reducing equity and adds debt to its capital structure. So that's because more debt increases the cost of equity, which exactly offsets the advantage of replacing some equity with debt. We looked at the impact of corporate and personal taxes on the M&M propositions, right? And how the government claims on profits and are minimized and maximized income to private investors when we have a world with tax-deductible interest payments, right? Optimal corporate strategy is to use the maximum possible leverage. So when governments impose taxes at both corporate and personal levels, that tax advantage usually is lower than if there's only corporate income tax only, right? So in some cases, higher personal taxes on interest may lead to net tax disadvantage for debt. We looked at the trade-off of benefits and costs that arise from using this financial leverage. CFOs claim that the capital structure decisions are important. The optimal debt ratio occurs where the debt's marginal benefits and costs are equal. The tax benefits of incremental debt fall as leverage increases because larger interest expense makes it more likely that the firm's going to lose money, and the firm loses money must defer realizing that tax debt shield, right? Bankruptcy, if that results in a costless transfer from shareholders to creditors, then bankruptcy would have no important consequence for a firm's capital structure. It is because the bankruptcy process triggers large direct and indirect costs that bankruptcy creates a cost to using debt. We looked at the use of debt and how that affects agency costs. Creditors know that corporate managers have incentives to expropriate their creditor wealth through their investment policy. So, asset substitution is one way that managers do that. It's promising to invest in a safe asset to obtain a return reflecting that risk, but then investing instead in a riskier asset that offers a higher expected return. So, creditors protect themselves from these problems by inserting restrictive covenants into loan agreements. Several important agency costs between corporate managers and outside investors and creditors in their relationship. So, in some cases, financial leverage can help overcome some of those problems. Sometimes it actually worsens the problems. So, the modern trade off model of corporate leverage benefits a firm's optimal debt level to set by trading off those tax benefits of increasing leverage against the increasing severe bankruptcy costs and the agency costs of heavy debt usage. And then finally, we looked at the pecking order and signaling theories. So the pecking order predicts managers are going to minimize the need to secure that outside financing by either retaining profits to build up financial slack, for example. These same managers are going to use the safest source of funding, usually senior debt, when they must secure the outside financing. And the signaling theory predicts that managers are going to select their firm's leverage levels to signal that the firm's strong enough to employ high debt and still fund its profitable investment opportunities. So this was chapter 13. If you guys have any questions on this chapter or any questions on your homework assignments, feel free to hop on to the office hours or send me a message and we can create our own Zoom meeting if need be. I'd like to help you if you need help. So again, just reach out and we will move on to chapter 14 next. Thank you.